Good afternoon, everyone. This is the Group 2, and we will discuss the Lesson 2 for the Managerial Accounting, which is the Financial Analysis. For the reporters, we have Lorraine Bonita, Diwata De Leon, Danica Sabino, Aubrey Malyari, and Denise Rolion. For the Lesson 2, we will discuss the following. We have the overview, objectives and course materials, standards for financial statement analysis, and lastly, tools and techniques of financial analysis. So for the first reporter, we have Danica Sabino.
Good day everyone, this is Danica Victoria Sabino, the first reporter of Group 2. First, let me know the overview of financial statement analysis. What is financial statement analysis? It is the process of analyzing a company's financial statements for decision-making purposes. Meaning, dito nagbe-base ang mga director to come up with a bigger decision na gagawin nila for their company or business. External stakeholders use it to understand the overall health of an organization as well as to evaluate financial performance and business value. External versus internal decision makers. External decision makers are people who lack direct access to the information generated by the internal operations of a company. These external decision makers use accounting information in deciding whether to invest in the business entity, extend credit, or even to do business with it. Firstly, sila yung nasa mataas na posisyon na namamahala and responsible for decision of the whole company or business. While internal decision makers are the managers of an entity. These managers are responsible for planning the future of the business, implementing those plans, controlling the daily operation of the business, and reporting information to the other operating officers. The process of developing and reporting financial information for internal users are called management accounting. The objectives of financial statement analysis. First, the assessment of past performance and current position. Past performance is often a good indicator of future performance. Users are interested in the trend of past sales, expenses, net income, and return on investment. Studying this trend offers means of judging how management performed in the past and also possible indicator of future performance. Analysis of current position is also important to determine where the business stands today. It will tell the relationship of debt to equity and also the extent of receivables and inventories. It will also tell the cash position is and show the ability of business to pay its maturing obligations on time. Second, the assessment of future potential and related risk. Assessing an entity's past performance and current position is important to answer different decision questions of financial statements user. For example, an investor wants to know the potential earning ability of a company because that ability will affect the value of his investment as well as the amount of dividends the company will pay. On the other hand, a creditor is interested in the debt-paying ability of the company for the protection of his loan to given to the firm. The riskiness of an investment or loan depends on how easy it is to predict future probability or liquidity of a firm. The return on investment will depend on the riskiness of the investment. The higher the risk, the higher will be the return. Likewise, the lower the risk, the lower will be the return.
That will be all, and we will proceed for the next reporter, Denise Rolion.
Thank you, Danica. Hello everyone, I'm Gabriela Denise Rolion and I'm your next reporter. So for my topic, it's the standards for financial statement analysis. In using financial statement analysis, users must judge whether the relationships they have computed are favorable. There are 3 standards of comparisons that are often used. So first is the rules of the thumb measurement. This provides simplified advice or some basic rule set regarding a particular subject or course of action. For example, it has been thought that a current ratio or current assets divided by current liabilities na 2:1 is acceptable. It is a general principle that gives practical instructions for accomplishing or approaching a certain task. So typically, rules of the thumb develop as a result of practice and experience rather than through scientific research. So dahil hindi siya scientific at hindi nito tinitake into account ang individual circumstances at needs ng isang tao, pwedeng hindi ito maging applicable to some particular situations. Ang rule of the thumb ay isang informal piece of practical advice na nagpo-provide ng simplified rules na pwedeng i-apply in most situations. Although such measures may suggest areas that need further investigation, there is no proof that they are the best for any company. Second is the past performance of the company. So, ang way na pag-determine ng standard na ito is by comparing financial measures or ratios of the same company over a period of time. Binibigyan ito ang analyst ng some basis for judging whether the measure or ratio is getting better or worse. This standard also helps in showing future trends. But just like the rule of the thumb measurements, this standard of past performance must be used with great care. So the third one and the last one is the industry norms. Industry norms, or also known as operating ratios, are used when comparing a company's performance to competitors in its industry. The financial information is converted into ratios in order to provide a basis of comparison. Ratios are calculated for categories such as liquidity, asset management, debt management, profitability, and market value. Ratios for a particular company are also compared with those for the industry as a whole or with those for a specific competitor or group of competitors. These are used to study changes in companies' operations over time. So, ang purpose nito is to identify and to analyze deviations from industry averages. But just like the two other standards, the industry norm standards have its own limitations. One such limitation is that even two companies that seems to be in the same industry may not be strictly comparable. And that is it for my part. Now here's Lorraine Bonita as the next reporter. Lorraine, pasok!
Thank you for that, Denise. Okay, so like what has been said, I, Lorraine Bonita, will discuss the first two techniques for analyzing financial statements, which are horizontal and vertical analysis. Let's dissect horizontal analysis first, which is also called as trend analysis. Here, at least two accounting periods are required for a valid comparison, and it is only applicable to use on balance sheets or income statements. Ginagamit ito to spot and evaluate trends over a specific period of time. So actually, mas preferred dito to include 3 or more accounting periods when calculating it. Adding a third year to the analysis will be even more helpful dahil mas madaling makita kung may definite trend bang nagaganap. So, by using horizontal analysis, may tatlong bagay kang makikita dito. First is the change in money, so you can quickly view any absolute changes in the actual values from period to period. Second, percentage change, so you can calculate the variance between the periods to determine whether the impact was positive, negative, or neutral. And 3, optionally, you can also get the ratio, which is used for seeing the gross margin or the profit. But this can also be expressed as percentages, or actually, this is percentages but in decimal form. Next slide. So here are some notes for using horizontal analysis. First, when you encounter the term base figure, tinutukoy nito yung data of the earlier period between 2 years you are comparing. For example, kung meron kang tatlong periods to compare like period A, period B, and period C, period A will be the base figure for A versus B, and period B will be the base figure for B versus C, since they are the earlier years. Another thing to remember is that if the base figure you have is equal to 0 or negative as indicated by a parenthesis, there will be no presentation of percentage change. So, how does this work? Okay, first step, naturally, kailangan mo muna mag-prepare ng at least 2 sets of period data into one table. And of course, yung mga years ay nakaput into columns. And then, add another 2 columns labeled respectively as amount and percentage. And since there are no standards for managerial tools, you can also add ratio if you like. Then, don't forget to nest these 2 last columns under the label increase parenthesis decrease. Also, i-note ko lang dito na ginagamit ang parenthesis to indicate a negative change in value. So now, you can calculate each row item using these formulas. To get the amount of change, the formula is just the most recent value minus base or earlier period value. For the percentage change, it is just the amount change over base period value times 100%. Or, kung gusto mong i-derive, it is the quantity most recent value minus base period value all over base period value times 100%, of course. And lastly, for periodic ratio, it is simply just dividing the most recent value by the base period value, like period B value over period A value. I also dropped here the gross profit ratio, just for additional knowledge, which can be obtained by subtracting the cost of goods sold from the sales and dividing it all by sales. In other terms, it is revenue minus expenses all over revenue. Okay, so meron na tayo nito. Now, let's examine this first example. Let's say, si Company A has these financial statements from 2018 and 2019. They have put it side by side for you to count as manager. So, for the first step, add 2 columns labeled as amount and percentage. Yan nga, ginawa. In this case, you also want to add ratio for the third column, and so you put it. And above these columns, we will write increase, parenthesis, decrease. And again, I will emphasize that parenthesis is used to denote the decrease in value. So now, to compute for what should be under the amount column, remember the formula most recent value minus base period value. In this case, it is 2019 as the recent minus 2018 the base period. So, dito nga, since 2019 is the most recent value natin, and ito yung base period, so 50 minus 40 is 10,000. 40 minus 40 is equals to 0, kaya dash. And so on, ganun ulit gagawin mo dito. Kaya 30 minus 40,000, negative 10,000. Ganyan. So, tuloy-tuloy mo lang yan hanggang matapos mo yung column ng row. And then, moving on to the next column labeled as percentage. Remember the formula, amount change divided by base period value times 100%. So, dito, ang gagawin mo lang naman ay amount change, meron ka na. So, 10,000 divided by base period value, 40,000. 10,000 divided by 40,000 times 100%, magiging 35%. And since dito, ang amount mo ay 0, naturally, magiging 0 na rin yung percentage nito. And dito, since 10,000 divided by 40,000 times 100, ayan, same lang siya. But of course, we have to remember the note from earlier. Ang sabi nga, if the base figure is 0 or negative, there will be no presentation of percentage change. So dito, since 2018 is our base period, any row containing a 0 or negative value from 2018 will automatically have no percentage change and just be written as a dash. So observe these rows from F and onwards. Since ito, meron siyang dash, meaning 0 to, 0 na rin to. And since negative ang values ng 2018 dito, wala rin siyang presentation. Next, our formula to get the last column, which is ratio, is to just divide the most recent value period by the earlier period value. Likewise, with the rule of percentage change, dito naman, only if the two period values are both positive, tsaka mo lang ma-indicate that there is a ratio change. So, tingnan natin dito. Sabi, most recent divided by base period, so 50,000 divided by 40,000, correct, 1.25. 40 divided by 40,000, 1. 30 divided by 40,000, 0.75. But yep, from row D onwards, wala siyang ratio because it is either the 2018 or the 2019 row value that is negative or 0. Okay, so for this last example, since we are in an online setup and syempre, as IEs, we have to be proficient with Excel, we will open it and try to do this financial statement from scratch. And here it is. So for the Meadow Corporation, you were given the comparative statements of financial position for the years 2019 and 2018. So the first step is to put a label amount and percentage. And then nest these two columns under the label increase, parentheses, decrease. So now we can move forward with the computation. Ang formula ulit ng amount is recent value minus base period value. So para makagawa ka ng formula dito sa Excel, just type equal sign and then select the data or the cell you are going to use. So 2019, and we have to lock this para etong 2019 column lang yung basehan niya dito. So, triple lock it by pressing F4 minus 2018 value. And then, triple lock this value again to lock the D column. And then, that's it. 189,300 daw. So, i-drag down na lang natin to para hindi natin kailangang isa-isahin pa. Kita nyo yung cross sign. Just drop it down or double-click it later. But yeah, ganyan. So, same lang ang gawin natin na formula for the liabilities and equity. What you can do is you can just drag this down, pero pakita lang ulit natin kung paano. So, equal sign, 2019 value, locked, minus 2018 value, locked. So, bigla siya hashtag, kasi hindi raw kasya yung sinulat mo. So, kailangan nito i-adjust ng onte yung row, or yung column rather. There's that. So, let's double-click this para ma-drop down. See? Meron ka na agad. Ganito rin naman yung gagawin dito sa ibang rows. So, let's just drag this down para mabilis. And of course, naturally, wala ditong lalabas kasi nga, wala naman dyang values. So, delete natin yan. Okay, now we're done with the amount. Let's move on to the percentage change. Again, the formula is amount change divided by base period times 100%. Since Excel to, di na natin i-indicate yung percent sign. Pwede naman yun since percentage na nga to. Okay, so the formula is just equal sign. Click the amount change and lock the column again. So, triple click F4 divided by base period 2018 and click and then times 100. Okay, so as you can see, bigla siya naging peso sign pa rin kasi naka-accounting ka dito. So what you can do is we have to change this to number para matanggal yon, and we don't have to put it into the percent sign kasi magiging thousands na value yan. So okay na siyang naka-number na lang. Drag down na lang natin to. Let's repeat the process for the liabilities. So again, equal sign times amount change, triple lock it, divided by the base period 2018. So 585,000. Lock the value again. And then times 100. Okay, so let's change this to number once more. Then, let's actually, para natin ituloy ito hanggang sa equity and sa total. So, let's do that. And don't mind this div since wala naman talaga silang values na katapat. And that's our value now. Meron na tayong comparative statements of financial position for the years 2019 and 2018. And that's it for horizontal analysis. Let's move on to vertical analysis. Dito naman, you are comparing financial statement figures in just a single period. It is also known as common size statements or percentage composition statements. Kasi hinahanap mo dito yung percentage of a common base figure of one financial statement. Imbis na independent and absolute numerical figures ang hinahanap. So each line item here is listed as a percentage of a corresponding item. Meaning to say, dito, ina-express natin ang lahat ng figures as percentages of a total. Like say, every line item on a balance sheet is stated as a percentage of total assets, or every line item on an income statement is stated as a percentage of gross sales. The formula here is very simple. To calculate the common size percent, just divide the individual amount over the total or base amount times 100%. Simple, di ba? So, practice natin tong example sa Excel. Okay, so ito na naman si Meadow Corporation. Ang hinihingi naman sa'yo ay common size statements of financial position for the 2018 and the 2019 years. So the first step to make a vertical analysis here is to put a label percentage kasi yun naman talaga yung goal ni vertical analysis. And then the next is to use the formula individual amount divided by total amount times 100%. So sa assets, ang rule nga sa accounting is that assets is equals to liabilities plus shareholders equity. So ang assets natin dito, ayan yung total natin. So ang magiging formula natin dito ay equal sign individual amount which is 868,400, and let us lock this again. Lock the B column. And let us divide this by the total amount which is 2,296,400. Ito, fix na siya. Ang cell na fix na to, hindi lang column, kundi pati yung row. Kaya, isang F4 lang para sila may dollar sign. And then, we just have to multiply it by 100. Okay, let us remove the peso sign again by converting this to number. Okay, so drop down na lang natin to para makagaya nila yung numbers, formulas rather. Yan. So, nakita nyo dito 100% kasi nga, sa kanya siya binabase. Ang meaning nito, the current assets is 37.82 of the total assets, whereas the properties, plants, and equipment is 34.89% of the total assets. Now, let's go to the liabilities. Same procedure. Nga pala, dito, note ko, since sabi nga natin, assets is equals to liabilities plus equity. So, ang magiging total base natin dito ay itong sa pinakang baba, total liabilities and shareholders equity. So, for the current liabilities, equal sign, the amount for 2019, which is 414,000, lock this column divided by the total, which is the total liabilities and equity. So, ito, fixed talaga siya. Isang F4 lang. Times 100. Ulitin natin. Dapat naka-number lang siya. Let's drag this down para same all throughout na dito. Yan. So, let's just remove these zeros. Kasi wala naman talaga silang values, nakakalito lang yan. So this is our percentage now for the 2019. But how about for the previous year, for 2018? Ulitin natin. By doing this, we can see a decrease in the yearly current assets from 46.2% to 37.8%. There's also a decrease in property, plant, and equipment from 45.3% naging 34.9%. At meron din ditong decrease in current liabilities from 39.8 naging 18% na lang, and so on. So, as easy as that, tapos na. So now, let us look at how horizontal and vertical analysis are comparably used. First, the difference in the name. Horizontal is also known as dynamic or trend analysis, whereas vertical is also known as static analysis. Also, please note na yung names of the statements we used for the two analysis. Horizontal is for comparative statements of financial position, samantalang ang vertical naman ay for common size statements naman. Second, kung ang horizontal analysis is used on multiple reporting periods, meaning 2 or more, and is usually quarterly or yearly, sa vertical naman ay ginagamit for only single reporting periods. Next, alam nating sa financial statements ginagamit itong dalawa, pero saan specifically pwede? Well, for horizontal, it can be used on balance sheets, income statements, or statement of retained earnings, whereas vertical can be used or can be applied on income statement, balance sheets, or cash flow statements. Fourth, with regards to audience, horizontal analysis is done for the management, investors, and analysts, but the vertical is more frequently shown for investors and creditors. Lastly, the purpose of horizontal analysis is to spot and evaluate trends across time and to improve and enhance constraints as seen when compared to previous years or periods. So dito, tinitingnan natin what drives a company's financial performance over several years and what trends or patterns is happening here. Pero sa vertical naman, we only do it to restate and compare changes during this specific year or period only and put it in a percentage form. We can also use this to compare company results with other companies in the same industry. And that's it for my report. The next one will be reported by Diwata Marie de Leon.
Thank you, Lorraine. Now, I'll be discussing ratio analysis and liquidity ratios. Ratio analysis is an important way to state meaningful relationships between two components of a financial statement. It can be expressed as a percent, rate, or proportion. It can be used to measure certain aspects of the business, specifically liquidity, solvency, and profitability. Liquidity ratios. Liquidity is the ability to pay bills when they are due and to meet unexpected needs for cash. Some commonly used liquidity ratios are 1. Working capital. It is the difference between current assets and current liabilities. So you get this by subtracting your current assets by your current liabilities. Second, the current ratio. It expresses the relationships of current assets to current liabilities. So you get this by dividing your current assets by your current liabilities. Third, the quick ratio. It is also called the acid test ratio. It is a test of company's immediate short-term liability. So you get this by dividing your quick assets by your current liabilities. The only difference between the two is that in quick ratio, you use your quick assets, while in current ratio, you use your current assets in computation. Fourth, accounts receivable turnover. It measures the relative size of a company's account receivable and the success of its credit and collection policies. You get this by dividing your net sales by your average account. Fifth, average collection period, also known as the average days sales uncollected. This represents the average time required to collect accounts receivable. You get this by dividing the accounts receivable by your average daily sales. Sixth, the inventory turnover ratio. It measures the relative size of the inventory. You get this by dividing the cost of goods sold by your average inventory. Seventh, operating cycle ratio. This measures the average number of days to convert inventories to cash. You get this by adding the average age of inventory by the average age of receivables. Average days in inventory. This ratio shows the number of days that inventory is held before sale. You get this by dividing your average inventories by the average daily cost of goods sold, or simply divide 365 by the inventory turnover, which again you get by dividing the average daily cost of goods sold by the average inventories. So 960,100 divided by 302,500. So the quotient is 3.17.
Thank you so much for that, Diwata. So hello, I'm Aubrey Maliari, the last reporter, and I will discuss the last two parts of the ratio analysis, which is the solvency ratios and the profitability ratios. First of all, solvency ratios. It says here that solvency ratio is a key metric used to measure an enterprise's ability to meet its long-term debt obligations. It also says that it indicates whether a company cash flow is sufficient to meet its long-term liabilities, thus is a measure of its financial health. So basically, solvency ratio refers to a company's ability to meet its long-term debts and continue to operate into the future. So there are three commonly used solvency ratios. First is the total debt ratio, second debt to equity ratio, and third interest coverage ratio. Let's first tackle the total debt ratio. This is the ratio of the total liabilities to total assets. It says here that it measures what extent of total assets are provided by the creditors. It is computed by dividing the total liabilities by the total assets, and for the result, the lower the total debt ratio, the better. Because for that, it shows that the company will be able to meet its long-term obligation or the maturing obligations in the future. We can see here in the picture below the total debt ratio of the Middle Corporation for the years 2019 and 2018. It is computed by dividing the total liabilities by the total assets. For the 2018, we got 0.59 and for the 2019, 0.70. So for conclusion, in year 2018, we have a better total debt ratio. So proceeding to the second one, which is the debt to equity ratio, this ratio compares the resources provided by the creditors with the resources provided by the shareholders. So this ratio reflects the strengths and weaknesses in basic financial operation of the business. So the high debt equity ratio equals to overtrading. So it means that the company is overtrading, which means it is handling a large volume of business on a small amount of invested capital. It also indicates that the business is depending on creditors to furnish the necessary funds to carry on its operations. So basically, the debt equity ratio is considered risky for lenders and investors because it suggests that the company is financing a significant amount of its potential growth through borrowing. To compute this ratio, we have to divide the total liabilities of the company over the total shareholders' equity. As we can see here in the picture below, we have the 2018 and 2019 debt to equity ratio of the middle corporations. As we can see here in the 2018, we have the 1.44, and for the 2019, we have the 2.39 debt to equity ratio. So as a conclusion, 2019 is a little bit higher debt equity ratio, which means the company is overtrading than the 2018 year. So for the last part of the solvency ratio, which is the interest coverage ratio, it is also known as the times interest earned ratio. It indicates the margin of safety for payment of fixed interest charges. It measures the degree of protections to the creditors with respect to interest payments. So basically, it determines how well a company can pay the interest on its outstanding debts. So the higher the interest coverage ratio is, the better, especially for the creditors. So to compute that, you have to divide the earnings before interest and taxes, which is also called as EBIT, by the interest expense. So as we can see in the picture below, it is the interest coverage ratio for middle corporation for the year 2018 and 2019. Their EBIT, or the earning before interest and taxes, was divided by the interest expense. You can see here that the interest coverage ratio for middle corporation worsened in 2019. Interest payments were protected by a ratio of only 4.88 times, while in 2018 it is protected 14.89 times due to a sharp increase in interest expense. Let's move on for the second part of the reporting, which is the profitability ratios. These ratios are a class of financial metrics that are used to assess a business ability to generate earnings relative to its revenue, operating costs, balance sheet assets, or shareholders' equity over time using data from a specific point in time. So basically, profitability ratios determines how well a company uses its assets internally to generate more income. Of course, a company's long-run survival depends on its being able to earn a satisfactory income. For this reason, evaluating profitability is important for both investors and creditors. Here are some examples of profitability ratios, and it is the profit margin ratio, gross profit ratio, asset turnover, return on assets, return on equity, and earning per share. Let's start with the profit margin ratio. This ratio measures the percentage of each peso revenue that contributes to net income. So it is computed by dividing the net income by the net sales. As we can see in the picture below, for the middle corporations, profit margin ratio for 2019 and 2018, we can see that the net income is divided by the net sales. And for the 2018, we have 9.6%, and for the 2019, we have 8.9%. For the second one, the gross profit. Gross profit is the difference between the net sales and the cost of goods sold. The gross profit ratio is computed by dividing the gross profit by the net sales. So as we can see here in the picture below, gross profit divided by the net sales, and for the 2018 gross profit for the middle corporation, it reflects it is 39.8%, and for the 2019 it is 43.6%. For the third one, we have the asset turnover. Asset turnover is a measure of how efficiently assets are used to produce sales. So it shows here how many pesos in sales are produced by each peso invested in assets. As we can see here in the picture, it is computed by the net sales divided by the average total assets. So for 2018, in the middle corporation, it is 0.91 times, and for the 2019, it is 0.74 times. For the fourth one, it is the return on assets. It measures the amount earned on each peso of asset invested. It is computed by dividing the net income by the average total assets. You can see here in the picture that the net income divided by the total assets. For the 2018, we have 8.7%. For the 2019, 6.6%. So for the fifth one, we have the return on equity. This ratio is very important measure of profitability from the stakeholder's standpoint. It measures how much was earned for each peso invested by the owners. So this ratio is computed by dividing the net income by the average shareholder's equity. So we can see here that the net income divided by the shareholder's equity. For the 2018, we have 21.3% for the return on equity, and for the 2019, we have 22.4%. So for the last one, we have the earnings per share. Earnings per share indicates the peso earnings for each ordinary share held. It is computed by dividing the net income by the average number of ordinary shares outstanding. We can see here in the picture below, net income over average number of outstanding shares. And for 2018, we have 3.82 pesos. And for 2019, we have 4.68 pesos per number or per ordinary share held. And that's all for the lesson 2 financial analysis report. Thank you so much for listening.